Explain like you are 5 years old. Ever heard people talking about bonds and investing in them, and then thought to yourself, but what does it even mean? Well, in this video, me, Cat Finance, is going to answer what they are, go through an example of how bond investing works, and finally, some quick facts that you need to know about bonds. So, let's get started! What are bonds? Put simply, bonds are just loans. The bond investors will buy a bond from a bond issuer under the promise that they will get their money back in a couple years. Okay, that's pretty simple. But what's the point of all that? Well, from the bond issuer's point of view, they're able to raise money which they can spend now, and that's very important. Companies, for example, can issue bonds, and they do this to raise money for growing their business. Not only that, bonds are also beneficial to the bond investors. It's pretty safe investment for investors where they will get the money they invested back and also earn more money from the interest. Let's break it down. Say you buy a bond, the price you pay for the bond is known as the face value. In this example, you bought this bond at a face value of $1,000. When you buy the bond issuer promises to give you back your money at a later date. This date is known as a maturity date, and this bond matures in 3 years. But that's not all. Like we said earlier, bonds also pay you interest along the way. This interest is called coupon. If a coupon rate is 5%, 5% of $1,000 is $50, meaning you'll get paid $50 interest every year. After 3 years, you, the investor, get your $1,000 back at maturity. Not only that, you also get paid the 3 coupon payments for a grand total of $1,150. Congratulations! Now you know what bond is. Have some summit. Now before you leave, here are 3 fun facts about bonds that you need to know about. Bonds are often known to be safer than stocks, but they're not risk-free. If the issuer goes bankrupt, they'll not be able to pay all your money back. This is called a default risk. Secondly, bonds and bond funds are not the same thing. You might see on your trading app bond funds as BND, and you might think this is a bond, but actually it's different. Bond funds are like stocks, kinda. It is essentially gambling on the bond market and whether you think it's going to go up or down. And it's important to know you can lose money if it goes down, so be careful. Finally, you might ask, how much should you invest in bonds for your portfolio? Just use a simple starting rule. Match your age to your bond percentage. So if you're 20 years old, aim for about 20% in bonds. Younger people usually hold more stocks because they have a lot of time before retirement, meaning more time of their investment to grow and to recover from the short-term market downturns. If you learned something new today, make sure you like the video. My goal is to make everyone a smart financial cat like me. And right now, we have an army of 106 budding financial cats. So make sure you subscribe, right? Meow!